Hey, what's up guys? I just want to say thank you for all the love and support for the video I made talking about Market Cipher. I didn't expect it to get as much attention as it did, and to all those that stuck around since I've uploaded the video, you're awesome. So based off the community response, along with what I've already been uploading content-wise, I'll be producing financial education content every once in a while, because it's something I'm really passionate about and hadn't even really considered doing before. So to kick off this new chapter in my channel, we're going to be talking about some of the most basic of the basic. What the hell is day trading? According to bbusiness.com, contrary to popular belief, it didn't even come or begin with the technological revolution. Day trading's first real appearance comes way back in 1867. Back then, day traders had to live close to stock exchange centers where brokers would read tapes that were printed daily by companies in regards to sales and other financial information that was calculated manually into a certain value. They would then buy physical prints of whatever stock they wanted to potentially sell for a profit at a later date. Pretty weird from how we view it today. Nowadays, especially in relation to most of you watching right now, we've gone to a revolutionary period where we can trade digital currencies 24/7 from the comfort of our homes and with ease of mind. Well, as much ease of mind as a day trader can have. The fundamentals of day trading began with a simple concept and one that pretty much all businesses rely on: buy low and sell high.
Buy low, sell high.
Buy low, sell high.
Buy low, sell high.
You try to buy low and sell high.
From 1867 to fairly recently, this is pretty much how all trading was conducted, just hoping the price of a stock or commodity you bought went up in price so you can make a nice profit. However, as technology changed, the way people looked at day trading changed as well. Introducing the candle. You've probably seen these before, either just glancing at a trading platform or seeing it online somewhere, but looking at a chart full of them, it probably doesn't make much sense to looking at it from an untrained perspective, so I'll go ahead and break it down for you. A candle in terms of trading is supposed to give you a play-by-play of exactly what happened to the market for a specific set of time. Each candle represents a slot of timed activity in the market called a time frame, like 15 minutes, 30 minutes, all the way up to a week or month of price action. You'll hear me say this a couple times, but price action means what happened to the value of the stock or cryptocurrency within a certain amount of time. So given that information, what does the candle tell us that happened in the time frame then? Well, it's broken up simply into three parts: the body, the color, and the wick. Not like John Wick, but like the candle wick. Starting with the color, it tells us whether the price went up or down in comparison to the last candle. The body shows us where the price started in that time period, and also shows us where it ended when its time was up. The wick shown here shows us the range of where the price went during that time, so no matter where it opened or closed at, it can be as little as a $10 difference or as big as a $500 one. All these are very important in making judgment calls in trading, and can ultimately affect whether you can afford that Lamborghini or have to take out a second mortgage. Now that you have candles and time frames out of the way, next is to understand how to read a chart, which isn't even really the hard part. But understanding where the price will go within a specific time frame is. Otherwise, well, everyone would be rich. This is the default chart that everyone sees when they launch their trading platform for the first time. Just glancing at it with the information I've given here, we can see that it's on a 15-minute time frame, which means every candle represents 15 minutes. We can also see whether the price went up or down on an individual candle, and we can see long-term whether the price went up or down. Knowing the general trend of the market is a big factor that you'll have to look at in the future. So since I specialize in cryptocurrency, we're going to be going a bit deeper into that and talk about a lot of the really important mechanisms you need to know before you start your journey. In cryptocurrency trading, it's a bit different from the buy low and sell high business practice we talked about a minute ago. With all cryptocurrency trading platforms, they are what's considered binary option platforms. Like how in binary, 0 means no and 1 means yes. The same thing applies for trading. Sell means you're betting the price will go down. Buy means you're betting the price will go up. Essentially, instead of just hoping the price will go in one direction, option trading gives you the ability to make money even when the market is going down. Pretty cool, right? Like I mentioned a second ago, the first couple buttons you'll see are called buy, sell, or long in short. Most people in the cryptocurrency trading community will call it by the latter, but it's best you know both of these things before getting into it so you won't be confused. Now you know what the buttons do. Let's say you decide the market is going to go up from its current point and hit the buy button. Now you have to decide on a couple of things: what type of order you want to use and how much you want to put into the trade. There are three types of orders you can use to enter the market, or potentially enter the market if certain conditions are met. The options are limit, market, and conditional. The conditional option is the only one that makes logical sense as to what it does, but the other types do need a little bit of explaining. A limit order is when you tell the platform, I will enter a buy position at this specific price, no more and no less. So say for example Bitcoin's price is at $9,000, and you put a sell limit order for $9,001. Your order will never activate if it doesn't go at or above the $9,001 price point you've given the platform. However, if you put a limit order that would technically be disadvantageous for the position you want at the price it's currently at, your order will be completed immediately. An example of this would be the price of Bitcoin being $9,000, and you put a buy order at $9,001. The market is as much as a competitive place as a fighting arena. Everyone is trying to get in and out at the best price, even at your potential expense. It's important to remember this. A market order is very simple. You'll immediately enter the market at the best price possible for your position. However, for various reasons I would advise against using this, and we'll get into why later. A conditional order, on the other hand, is slightly more complex, in which you're telling the market if the price hits a certain point, then activate a limit order to be potentially filled at a predetermined price. I personally rarely use this, as it doesn't make much sense for me to do so, but the option is there. From here on, we're going to be discussing order sizes, and how you handle putting your own money on the line. The actual hard value of your order is measured in contracts, which is based off the US dollar. For example, if you put in an order for 100 contracts, you'll put in $100 worth of Bitcoin into the trade, either up or down. It's a fairly simple concept to get. It's been all fun and games at this point, but now it's where things start to get a little bit serious. We're going to start talking about leverage. It's very uncommon for a cryptocurrency platform to not offer leverage trading, as it's extremely popular and profitable for both the platform and the people who know what they're doing. The best way to explain leverage trading is by comparing it to buying a house. Most people can't afford to pay the full price of a house in cash, so they get the help of a credit union or bank to fund most of the purchase, only costing you a small portion of the house's actual worth. Technically, this is leverage at its core, using a small amount of your money to make a big purchase by borrowing money for the rest of the value. Most, if not all, cryptocurrency trading platforms let its users capitalize on this option. The way it's implemented in trading is by increasing the value of your order, but keeping your contribution size the same depending on how much you want to raise the stakes. Exchanges offer leverage sizes from 2 times, 5 times, up to 100 times the money you're putting in. Say for example I put $100 on the line for a trade at 100 times leverage. That means I'm entering the market with an order value of $10,000. That sounds awesome if you're always a consistently winning trader, but since you're smart, you've probably already considered, what if the trade doesn't go my way? That's where liquidation comes in. Every time you fill an order in the market for a leveraged position, there will be 3 prices listed to you. The price you entered, the current market price, and the liquidation price. The liquidation price is the point where you've lost as much money as you've contributed to the trade, and the exchange exits your position for you at a 100% loss, which is usually terrible, by the way. And if this does happen, usually there are extra small fees for the exchange's trouble, so usually if that does happen, you lose a little bit more than what you risked in the first place. Leveraging for the most part is the whole appeal of day trading Bitcoin, because of its volatility and how you can rapidly increase your money if you confidently and reliably enter winning trades. At this point, it's easy to realize leveraging is a double-edged sword. It's only useful to those who absolutely know what they're doing and how to properly use it. For new traders, I would highly advise staying away from this until you have a strategy in place that you know works. To further harp on the dangers of leveraging, profits and how successful a trader has become is measured in percentage gains. Using basic math, if you enter a position with 100 times leverage, that means you're only contributing to 1% of the total order value. If the trade will automatically close when you've lost as much as you put in, the price only needs to change by 1% in the wrong direction for you to lose the entire trade. Leveraging isn't something to be morbidly afraid of, but it's definitely something you need to consider and watch out for if you plan to use it. Now, we've pretty much gone over a lot of the technical stuff just to give you a basic understanding, but at this point, we're going to get into the info you will really use when you launch your platform for the first time. I'm using Bybit as my trading platform, mostly because of its low fees and it's pretty damn easy to use. Starting from the top to bottom, I'll explain everything you see and why you need to know about it. On the very top bar, you can see a couple of tabs: the current coin you're viewing, and also some price action information. On the Assets tab, you can see your balances for all of your cryptocurrencies, and also your order history and total profitability. This is super important to keep track of to see how much you're paying in fees, and if you're being profitable or not, considering you don't already manually track your trades. On the More tab, it's a bit more information on your account, FAQ, and other documents relating to the exchange, which you'll probably use more than once just to make sure you know all the details. On the right you have your actual ordering tab, the order book, as well as the recent trades tab to show you a live feed of what orders everyone is putting in. The order book shows you how many buy and sell orders exist for a certain price level. There's two major components to it that you should know the difference of: the platform price and the mark price. The mark price is the actual price of Bitcoin updated live, and the number to the left is the actual exchange value. But why are they different? It's because Bitcoin isn't backed by anything other than pure demand for it. The exchange's value for the coin fluctuates around the real price of Bitcoin, because even though, for example, the mark price might be higher than the exchange price, it might be because everyone on the exchange is trying to sell their Bitcoins, therefore the price is lower, and the same thing vice versa. On the far right is where all the action and decision making will be taking place. This is where you decide what kind of order you're going to use, the order price, how much you're going to put in, as well as the level of leverage you'd like to take advantage of. Here you can see the total value of your order with the leverage applied, how much money you have in your balance, and also the actual cost to enter the position, or whatever amount you'll be contributing to the order. On the bottom of that same panel, there are two really useful checkboxes, and I'll explain exactly what they do. The post only checkbox makes sure your order isn't automatically filled. Why would you not want your order automatically filled though? It's because most exchanges have a fee and rebate system depending on how your order is executed. There's a market taker fee that is applied to any position that automatically gets filled, costing you 0.075% of the total position value. This doesn't sound like much, but if you're using a higher leverage, it can really put an impact on the profit of a good trade and make losses that much worse. However, there also exists a market maker rebate that rewards you 0.025 of your position size if your order doesn't get filled immediately. If you enter and exit without your order immediately getting filled, you are rewarded 0.05% for trading instead of it costing you 0.15% in fees. This is why checking the post only box is so important to secure as much profit as possible. The other checkbox is to only reduce your other position that exists and not enter you into a new one. On the bottom of the platform you will see a couple tabs. The only important ones are called positions and active. The only difference between these two is that active is an active order that hasn't been filled yet, also meaning you haven't officially entered the market. If you see your trade in the positions tab, that means your trade is officially in the market and is live, and depending on the price when you exit will mean either more money or less money than when you entered. One more thing before we wrap this video up for you, and I promise it's important. Let's just say you entered a trade. Essentially the last and arguably most important step has come up: setting up your stop loss, take profit, or trailing stop loss. These are pretty easy to understand, and 99% of traders use at least a stop loss when trading. A stop loss is basically setting a net for yourself to cash out of your trade if it doesn't work out in your favor, and avoiding potentially a deep loss. How it works is you tell the exchange an exact price you'd like to cash out for a loss, either big or small. It's all dependent on you. Hitting your stop loss isn't always a bad thing, and especially seeing how a market unfolds after your stop loss hits can make you glad you did in the first place. Next is a take profit, and just from the name it's pretty simple to understand what it is. In principle, it's just securing your profits while you're in the green, meaning your trade at that current point will turn a profit if you closed it. Just like how a stop loss works, you set a specific price point for the exchange to cash you out, but this time for a potential profit. Lastly is the trailing stop loss, which, like the conditional order type, is a little less straightforward than the rest. With this type of potential close, there's an active stop loss set. However, it is an adaptive stop loss that moves around with the price. How it works is that the trailing stop loss follows the price movement if it is in your favor, and stays at a certain level if the market moves against your interests. Then it will close out if it falls too far from its highest point. A good example of this is entering the market at again a $9,000 Bitcoin value, and you place a trailing stop loss telling the exchange, hey, if the price goes $100 down from this highest point since it entered, exit the trade. If the price moves up to, say, for example, $9,500, your stop loss will now automatically be set to $9,400. But if the price then moves down to, say, $9,450, the stop loss will remain at $9,400. Again, just to make it clear, if you entered a buy position, for example, and set a trailing stop loss for a $100 difference in value, the stop loss will keep a $100 distance from the trade if it goes up. However, it will only follow until its highest point. If the price falls $100 or more from its highest point, the trade will then be closed. It's the same idea if you were in a sell position, however in reverse. This is a great type of automatic closing system that lets you ride waves of a trade in your favor without closing out too early. I would still only recommend this to people who know what they are doing. The only downside to using these types of exits is that you will be charged the market taker fee of 0.075%. I wouldn't worry too much about that, as I'll explain how to avoid this in a later video. But what's important right now is that you understand how everything works first. That pretty much sums it up for Trading 101. We've covered an absolute shit ton of information in this video, but I hope you all learned something valuable from watching and consider using this as a reference for trading in the future. If you haven't already made an account, just sign up for Bybit using the link down in the description to get started, and it also helps me out a little bit. It's honestly the best exchange out there currently for beginners especially, and one I still enjoy today. Just to keep you all updated, I do have a strategy I've been developing for a couple weeks that so far in live trading has had pretty good results. If you do want me to make a video about it in the future, go ahead and leave a like and comment. And if you are new to this channel, go ahead and hit that subscribe button so you'll know as soon as I release it. If you have any questions, feel free to reach out to me and other experienced traders in the Discord link down in the description. Or if you have any questions, go ahead and leave it down in the comment box. Thanks for watching.